Gentleman from Florida, Mr. Posey.
Thank you, Mr. Chairman. Madam Chair, the number one thing I hear from my local community banks and credit unions is the need for regulatory relief. That's not news to you, obviously, either. And these financial institutions provide critical services to our communities, and they're worried that the overregulation is hurting not only their ability to provide those services, but eventually is clearly leading to increased industry consolidation. I'd like to ask you what you consider to be the negative consequences, if any, that result from consolidation and the effects on the local and national economy.
Well, I think community banks play a vital role in supplying credit to groups of borrowers who larger banks often would not be able to serve. And that is a vital role in all communities throughout the country. So we want to see those banks thrive and are very focused on ways that we can reduce burden on those banks. I mentioned earlier some of the things that we've tried to do to reduce burden, and we will continue looking through the Agrippa process and by the regular meetings and contact that we have with community bankers to address the burdens that they face and look for ways to simplify regulation and reduce burden.
Madam Chair, do you think that relationship lending is important?
It's been very important often for community banks in the kind of business that they do, so yes.
Just a quick follow-up. Can you identify some areas of priority at the Fed for reducing regulatory burdens on community banks?
Yes, so we have been focusing, for example, on the duration of our on-site reviews and looking for ways to have our examiners spend less time on bank premises. We've been looking at ways and have simplified and tried to tailor our pre-examination requests for documentation. We've been conducting extensive training for examiners to make sure that our guidance is properly interpreted and applied in ways that are consistent. We have a number of fora in which we try to help community bankers understand what new regulations or proposals are relevant to them and which ones are not intended at all for their organizations. As I mentioned, the Agrippa process is ongoing, and we've been holding fora around the country to hear the concerns of banks with regulatory burden, and will take all of the steps that we possibly can to address the concerns that surface. We meet regularly with community bankers through an organization called CDAC, which is composed of representatives from each of the 12 Federal Reserve districts. They come to the board, and we meet with them twice a year, the full Board of Governors, to discuss their concerns, and we follow up on what we hear.
Thank you. Finally, this week, the House is considering legislation that would require the administration to put forth a detailed plan to reduce the national debt whenever the debt limit is increased, a common sense concept, I believe. We also just received the President's budget request, which would, in the face of a 19 trillion, we just passed the 19 trillion mark in the debt clock, increase spending by 2.5 trillion. When the President took office, the national debt was roughly $10 trillion. When he leaves office, the debt is expected to have doubled to about $20 trillion. You've also voiced your concerns about the impact of failing to raise the debt limit, failing to pay our bills, citing the impact it would have on the economy. I don't disagree, but I'm curious, do you have similar concerns about the impact on the economy of failing to address our national debt? How much debt do you think is too much?
Well, I think if you look at the path that the U.S. debt is on under current policies, it will rise from the present level to levels well above 100% of GDP and continue rising more or less indefinitely. And wherever you draw the line, you've got to conclude that that's an unsustainable economic situation. So I think it's essential that Congress address this longer run budget deficit issue.